In this lesson, how to trade double tops and double bottoms. The learning objectives are: you should understand the double bottom and top formations, and you should know how to properly enter a trade using the double top and bottom pattern. Double tops and bottoms are reversal patterns that signal an upcoming reversal of the underlying trend. A double top pattern usually forms at the top of an uptrend, with the price failing to form a fresh higher high. Instead, the price finds resistance at the previous swing high, would be this one, and reverses, forming two highs at roughly the same price level. A double bottom is quite similar to a double top, only that it usually forms during downtrend and signals an upcoming uptrend. In a double bottom pattern, the price fails to form a fresh lower low and finds support at the previous swing low, which now acts as a horizontal support level for the price. A double bottom pattern is recognized by two bottoms in the chart roughly at the same horizontal level. These patterns typically appear after a trend move. You cannot confirm the pattern in the absence of a trend. Although tops and bottoms can and do occur when the market is not trending, a valid top-bottom formation must exist in the context of a trend. To initiate a trade based on this pattern, you should first confirm its validity using the neckline and a breakout. You draw the neckline at the horizontal level at the bottom between the tops. Opposite to this is the neckline of the double bottom pattern, and is just the horizontal level at the top between the bottoms. You have to manually add the neckline on the chart. The neckline plays the role of a trigger for your trade. Therefore, this level is of great importance for your pattern. I would like to add though, that by waiting for a breakout of this neckline, you reduce the risk of the trade, but you also reduce the amount of profit you can potentially make from the trade. Also, if you wait for the breakout candlestick, which is this one, to close below the neckline, you would also avoid fake breakouts and increase the success rate of your trade. Although this one did go back up, it did eventually go down and would have ended up being a profitable trade. Just so you know, if you don't know already, if you have a double top pattern, you'll wait for a bearish breakout, and if you have a double bottom pattern, you should wait for a bullish breakout. You can also combine various technical indicators to improve the success rate of a trade based on double tops or bottoms. Candlestick patterns are a great tool to use in any trading strategy and can be used to confirm the trading signal of a double top or bottom pattern. If the price breaks above or below the neckline with a strong Marubozu candlestick, the success rate of the pattern will be much higher. RSI is commonly used to identify overbought and oversold market conditions, and as a momentum indicator, it measures the magnitude of recent price movements and can be used to measure the strength of the double top/bottom pattern. After the neckline breakout, if the price makes a fresh high after the break of a double bottom neckline, or a fresh low after the break of a double top neckline, and the RSI follows, it means that the underlying move has enough strength to continue. On the contrary, if the price makes a fresh high but the RSI fails to follow, it indicates a bearish divergence, and the breakout may prove to be a fake one. Similarly, if the price makes a fresh low but the RSI fails to follow, it indicates a bullish divergence and the breakout may prove to be a fake one. Another indicator you may use is the ADX. It is a popular indicator that measures both the strength and the direction of an established trend. Since double tops and bottoms are reversal patterns, the ADX reading should confirm that a trend had been established before the formation of a double top/bottom pattern, meaning that before the pattern forms, the ADX should be above 25. Another good way to trade double tops and bottom patterns is to use pullbacks. Since the neckline of a double top and bottom pattern basically acts as a support and resistance, you can wait for a pullback to enter into the direction of the breakout. This approach usually returns the best results when trading double tops and bottoms, as the rejection of the neckline area confirms that a large number of market participants are following those levels. The pullback approach is great if you've missed the initial breakout. You can confirm a pullback if the price forms a reversal candlestick pattern at the previous broken neckline. This could be a bearish engulfing at this level here, at the retest. You should always secure your open trades with a stop loss. Although the success rate of these patterns are relatively high, there is never a guarantee that the trade will work in your favor. The optimal place to place your stop loss is just above the second top of the double top reversal pattern, but it depends on your risk management rules and personal risk tolerance. So what I'm referring to at this top, the second top, is this one here, and you'll place it here. If you don't want to take too much risk on, you can place your stop loss just above the neckline. If you enter at the neckline, you can place it just here and enter a sell here, because you'll be hoping that the neckline would act as a resistance, preventing the price hitting your stop loss. But if you don't mind risk so much, you can have a wider stop and place a stop loss just above the double top pattern, so here. I wouldn't recommend this because it could mean that you have much higher losses. However, if you think you know what you're doing, it does allow for the price to fluctuate, because sometimes the price could briefly go back above the neckline only to fall back down. But if your stop loss is too close to the neckline, you could be stopped out, meaning you take a loss while your trade still goes in the right direction. And for setting profit targets, you should use the structure, meaning the double top pattern, to extrapolate how far the potential price move could go. Because you can set your profit target to be equal to the height of the pattern. You can measure the height of the double top pattern from the neckline to the top, and then put the size down to get the profit target.